welcome back. This is The Firm. Related party transactions are one of the most widely used ways that controlling shareholders exploit the rights of minority shareholders. I'm not saying that. OECD is. It is to fix exactly this problem that the Companies Act 2013 provided for the first time that material related party transactions must be put to shareholder vote. SEBI's Clause 49 on corporate governance followed suit. In a nutshell, listed companies in India have to seek shareholder approval for any related party transaction where the amount exceeds 10% of turnover. The law and regulations seek to empower shareholders, but companies are doing their bit to keep shareholders in the dark. Proxy advisory firm IIAS has identified several shareholder proposals on related party transactions where amounts and time periods are not specified. Worse still, some companies are seeking blanket approval from their shareholders. Are companies taking shareholders for granted? To discuss that, I have with me Amit Tandon of IIAS and Sandeep Parekh of FinSec Law Advisors. Gentlemen, to both of you, a warm welcome. I'll start with quick opening comments on how in the last year or so since the Companies Act has come into effect, the entire regime around RPTs has changed. What I really want to know from both of you is, have you witnessed companies showing a degree of more transparency when it comes to the related party transactions that they report to shareholders?
Sure. Look, let me begin by saying that we do recognize that your companies are going to be entering into related party transactions, and we don't necessarily believe it's bad. At the end of the day, it's an operational decision. Company managements need to take it. They need to decide who they want it with. There might be a higher degree of comfort in dealing with a known party or someone who's related rather than dealing with someone who's completely new. But having said so, our own belief is that now that you have the regulations asking you to put these recommendations or these resolutions to vote, you might as well then give some more clarity to shareholders when you're seeking their approval.
Yeah,
so
and you know that clarity works in different ways, right? For instance, and I'm not referring to a related party transaction, but Tata Motors had a run-in with shareholders when it came to the remuneration of some of their key managerial personnel. The second time round when they put that to vote, by providing more detailed information to their shareholders as to why they were exceeding certain permitted limits, they managed to get shareholders onto their side. Right? It was about communicating effectively to your shareholders. We've seen related party transactions, you know, in the case of, for instance, United Spirits, or even not yet put to vote, but in the case of what went down with Maruti and its Gujarat plant, where institutional shareholders, public shareholders, have stood up and said, look, we're okay with this, this and this, but we're not okay with these related party transactions. A more active regime?
So let me take you back to Satyam, the famous board meeting.
Metas.
Yeah, and if you remember, the law that time allowed the director, the interested director, to sit in the board meeting. The section 300, 301 of the old act basically said they could not vote at the director level. But there were pretty much no other prohibitions. So we are today, I mean, OECD has of course come out with this. India had a huge problem of abusive related party transactions, and only a couple of countries have this level of approvals of directors, audit committees and shareholders. So which is, I think, a good development, because the fact is that a lot of abusive practices were going on. So I think we have come a long way.
We've come a long way. Okay, we're going to test that, whether we really have come a long way. In May 2015, Goodyear sought shareholder approval for related party transactions with a fellow subsidiary. The transactions cover everything from providing services to sharing employees and infrastructure to purchase and sale of goods. Approval has been sought for an indefinite period of time and for unspecified amounts. Lumax Auto Technologies doesn't even bother to describe the various related party transactions it proposes to undertake with Lumax Industries, except to say they involve the purchase and sale of raw materials, finished goods, etc. There is no mention of the time period or amount. AstraZeneca Pharma India has asked shareholders to approve a formulation, packaging and distribution agreement with its British parent for, again, an indefinite period of time and an unspecified amount. At INFS Transportation, shareholders have been asked to approve related party transactions of up to 10,000 crore rupees per annum with present or future related parties, of which about 40 have been listed. In all cases, the ones that I have outlined, IIAS has advised shareholders to vote against these related party transactions. You're calling them blanket approvals and you're absolutely opposed to them.
Absolutely. Our way of looking at it is fairly straightforward. Are you giving shareholders some information on which they can vote, or are you pretty much saying that let me do what I want to do? So all these cases fall under the category of let me do what I want to do. I have a requirement, so I'm kind of putting it to vote, and after that I will continue to do what I do. So that's kind of the acid test which we've applied in all these cases and asked shareholders to kind of step back and not support the transactions.
My first comment is I think they're egregious communication pieces in terms of I think if they were able to kind of put it well together in terms of why these related party transactions are in most of these transactions, which we are looking at, they are kind of critical and important part of doing business. On the legal point, I'll come back to it later, but
no, come back to it now.
Okay.
Are such blanket approvals permitted? Because I think from what the Companies Act says, you can take approval only for a year, if I've got that correctly.
That's right. It says omnibus resolutions are valid for a year.
So let me explain that. See, I read all these things pretty carefully, including the Companies Act, and my sense is they are all within the law. All these resolutions which I have seen, I'll explain why.
Okay.
The reason is that the omnibus limitation of 1 year applies only to the audit committee, which is why there is no restriction on shareholders giving 5-year or 10-year blanket
or
approvals.
even open-ended, according to you, because some of these are open-ended. There is no kill date to them.
That's what the legal provision is, and that's how these people are reading it. May be cute, we may not like it, but all of them are consistently. And let me supplement it before you come to it. Section 188 of Companies Act gives a blanket exemption for ordinary course of business, arm's length transactions.
Correct. But clause 49 overrides that. And says if it amounts to 10% or more of turnover, you must
Let's slow down.
There is a limit.
Let's slow down.
There is a percentage.
Okay, finish your point before I go down it.
No. So what I've seen, these 6 transactions which I saw today, each one of them says that 188 does not apply to us because these are at arm's length.
Yeah.
They are complying with clause 49.
Correct.
Which has 2 parts. The first part is audit committee, which says you cannot give blanket approval except audit committee cannot give for more than 1 year. It is silent about whether shareholders can give for more than 1 year, which is what they're exploiting. It may be cute, it may not be illegal. And the second thing which is really happening here is what I said earlier. It's just really awful communication.
If you actually look at it, a couple of these companies are multinationals, and if anyone who's worked at a multinational will tell you, the senior management spends all their time filling in Excel sheets on a month-to-month and a quarter-to-quarter basis. So there's no reason why at least a basic minimum information can't be provided. You could say that, look, last year we've entered into such transactions aggregating about 900 million. This year, other things being the same, it could be a little bit higher or a little bit lower, but even that little bit of communication is not being made.
Okay, there are 3 things I want to say in defense of these companies, especially because the companies are not here. Firstly, I think the provisions that Goodyear put to vote, or the resolution that they put to vote, have received the requisite approval and more. So the ones that have been voted on have sailed through to that extent. So let me put that out, right?
Let me just come back on Goodyear. There was actually quite a lot of engagement between a set of shareholders and the company, and what the company then said was that they will have a meeting and saying that, look, if there are any changes from the existing arrangement, because the shareholders were happy with the existing arrangements, will come to shareholders to vote.
Which has given
shareholders
some degree of comfort. I get that.
Which has given some comfort.
Equally, many of these companies, including Goodyear, have said, look, the contract is available for you to go and look at our registered office. Now, I'll admit not too many shareholders are going to go to the company's registered office to look at the contract, the details of which are missing maybe in the communication to shareholders because it's way too bulky, I could imagine. But if you really were one of those shareholders who wanted to question them, you could go to the registered office and seek a copy of the contract and look through it and then raise any issues if you may have.
You could do that, but at the end of the day, it's so much easier now with technology, companies being able to at least, I understand you could turn around and say it's got commercial implications for me, but you could share a little bit more than what you've done.
And one final piece of defense, and that specifically has to do with IL&FS transportation and other infrastructure infrastructure companies like it. They have made the effort in their explanatory statement to explain how in the infrastructure business you need to create so many SPVs. Here's how the SPV does business or transactions with the parent. Here's what the parent provides for the SPV. Here's what infrastructure agreements and bid contracts, etc. require. Therefore, we need to undertake all these RPTs, but we're capping it at 10,000 when we are asking you for your approval. And the current list of RPTs we have, which are 40, we've listed all of them, but we can't tell you which future ones will have to be created depending on the bids we enter into in the course of the year, and hence those will have to be added onto this list. That seems like a fair explanation, doesn't it?
They've laid out a rationale, but at the end of the day, it's both present and future. We don't know what they'll create, what they'll do. So therefore, all I'm saying is it's a little bit of the same mold as let me do what I want to do.
I think the broad picture has to be that if they're not abusive, then we should let the boards take course. And
so you don't agree with the voting action that IIS has recommended on many of these?
Not necessarily, but I do agree that all of them are kind of wanting in terms of communication.
Okay, fine. Let me try and now highlight some more. Earlier this year, SQS India BFSI sought and received shareholder approval for availing and rendering of services with its foreign parent of up to 97.5 crore rupees each. That's just about half the total income of the company, which is 215 crore rupees. That's what it earned last year. The time period in this contract, unspecified. Action Construction Equipment, ACE, sought and received approval for related party transactions, including the transfer of about 1.75 crore rupees to its CSR fund. Its profit for FY14, just for the record, was 4 crore rupees. Igarashi Motors India, whose revenue for FY15 was 385 crore rupees, proposed related party transactions of up to 1,100 crore rupees for 2 years, that's up to March 2016, even though all public shareholders and 73% of institutional shareholders voted against the RPT proposal at Igarashi. The promoter votes ensured its passage. Again, on all three counts, IIS has expressed concern regarding the quantum of the related party transactions and hence recommended voting against them. Your only problem here is that the amounts in many cases seem like half of total income or exceeding, total income as pointed out in the Igarashi.
It's radically high, so you might not as well come to shareholders to ask for it. It has to have some linkage with the existing size of operations.
See, first of all, Igarashi I'm not commenting on because they're my clients.
Sure.
But the broad principle is that it's coming to shareholders only because it's material. Many times 50%, 70% of turnover. But if it was below 10%, it would not even come to shareholders. So, that's the legal requirement, really.
Okay, but in the case of SQS, in the case of Action, this got approved by shareholders.
Right. That's right.
In the case of Igarashi, and we'll leave Sandeep out of this part of the conversation, all public shareholders voted against the related party transactions. Right. 73% of institutional shareholders voted against the related party transactions. Right. But because they make up for a very small percentage of the shareholding, and the promoter, interestingly, voted in this transaction, obviously in favor of the RPTs, the proposals passed or the resolution passed, right? So that's a slightly bit of an outlier.
Yeah. We are not sure what the scrutinizer has done in this case, what the regulators and what the exchanges are doing. But at the end of the day, the question we've asked the company is how did the promoter get to vote on something which is clearly proposed as a related party transaction? They cannot.
Okay, so IIS has asked the question, are companies taking shareholders for granted in doing what they have, as I've illustrated, with many related party transaction resolutions? Would you say they're taking shareholders for granted?
I would say somewhat. Number one, communication, which I've been talking again and again about. And the second, I think, is they've acted a bit cute with the fact that if the Companies Act does not get invoked because it's supposed to be at arm's length, and all 6 of the ones which I saw today were all at arm's length, and therefore they all of them said 188 does not apply to us, Companies Act does not apply to us. And all of them are fulfilling the clause 49 requirement, which curiously has very strict standards for the audit committee, but has no requirement for what has to be disclosed to the shareholders in the notice, which is where the cuteness is coming from.
All right, gentlemen, on that note, I'm going to have to wrap it up here. Thank you to both of you for joining us this week on The Firm, and thank you very much for watching.
The Firm, India's only show on corporate law, tax and audit matters.